Good morning. Welcome to Stock Market Today. It's Monday, October 26th, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I am at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. Also give you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities closed higher in Friday's trading after rebounding from midday lows. Comm services, consumer discretionary, those are your leading sectors, while energy and technology were the only sectors to finish lower on the day. Treasuries were mixed. The dollar was slightly lower against the yen and euro, but stronger against sterling. Gold was slightly higher. WTI crude was down 1.9% on the day to wrap up the week. And as we get to the desk this morning, futures are lower. S&P futures down 90 basis points after the index snapped a 3-week winning streak last week. Asian markets mostly lower overnight. China, the worst performer. South Korea also lagged. European markets are under pressure, for the most part, down about 1%. Treasuries are bid across the curve after yields saw a big back up last week and a lot of curve steepening. Dollar stronger on the major crosses, predominantly against the euro. Gold down 30 basis points. WTI crude is down 2.5%. That's largely playing out as the dollar is moving higher. We know the inverse relationship between the dollar and commodities. So let's take a look at the structure of the markets here. There were a lot of moving parts last week, whether we were talking about rising coronavirus cases, whether we were talking about the election, whether we were talking about stimulus. And for the most part, we just kind of went nowhere. Some puts and takes early in the week. Strength was being sold late in the week. Weakness was being bought. But for all the back and forth, for all the headlines, we went nowhere. SPY key level still 340, 320 below that. As long as we're above 340, I think the highs are in play. The September highs are resistant. Same goes for the Qs. Just adjust the price point. 280 is near-term support, then 260 below that. If we're above 280, you're playing for the September highs as resistance. And the IWM 160 is the near-term support level, bounced right off of it last week. Should we break there, we have to start thinking about 140. And for IWM, we're looking at the February highs as potential resistance. And if we're above 160, that's what we're playing for. All the noise in between, you have to decide for yourself what kind of trader you are. Are you a trader? Are you an investor? If you're a shorter term day trader, then you're paying attention to all that noise in between. I, for one, am not. I'm not going to help you there. It's not how I look at markets. Taking a trend perspective, a more intermediate term, and then identifying the relative strength within the framework of the market that I lay out here. That's where I'm going to add value, and that's where I'm going to be helpful. So we lay out the roadmap, tell you where we think we're going based on that roadmap, and then try to identify the strongest and weakest areas of the market. So right now, above 340 for the SPYs, above 280 for the Qs, above 160 for IWM, you're positioning for the highs, right? Does that mean we can't go down today? Of course we can. We're down 1% this morning. But I don't care until those levels break. That's how I'm viewing the world. Our market in a minute now. What are we writing about in the note today for Chaikin Analytics clients? Well, SPY and Q are oversold and above support. That's what's important to me. And that's what's important to the way that I look at markets. Small cap leadership is a bullish breadth and risk signal. Remember, we've been talking about small caps a lot. We've been saying, we were saying we just want to see them participate. And they did. They've participated to the upside. That's a breadth development. Now, what we're actually seeing is small cap leadership, i.e. outperformance. That's a risk development, i.e. pointing to more risk taking in the marketplace. So I think that that's encouraging as long as our levels hold. I'm wondering if Treasury weakness is pricing in that inflation theme we've been talking about. I think it is. It's more of a rhetorical question than anything else. Dollar remains in the range, and it is the key chart for risk assets, and it's not really going anywhere. So, for all the back and forth we mentioned on equities, if you just watch the dollar, you kind of had your clue on risk assets for the most part. We went nowhere last week, and the dollar was indicative of that. Futures, as I said, point to a lower open here today. Now, the major indices from a power bar perspective, the Dow deteriorated actually 2 to 7 bulls to bears there after losing 11 basis points on the day. S&P 500 added 30 basis points on the day, 140 to 80 bulls to bears. The Nasdaq 20 to 12 bulls to bears. Really, over the course of the last week, the only power bar ratio to strengthen, I was doing the work over the weekend, the only power bar ratio to strengthen last week was small caps. Okay. Small caps saw strength in their power bar ratio, ever so slightly, but strength. Qs deteriorated in a big way. And the spies deteriorated a little bit. So just something to keep in mind, right? So you're watching those key levels, but what about small caps, right? We've been talking about them a little bit. They're starting to come on. We're starting to focus more of our attention there because that looks like it could be leadership here. So that's what we're taking a look at. Bonds uptick, sending yields lower, a little bit of a flight to safety there, if you will. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Major indexes are mixed. It's our stock of the day now. This is one we've talked about quite a bit. We were actually talking about it throughout the summer, back in this $30, $35 range here. Green Dot, GDOT, the ticker symbol, closed at 59.78, up 1.87% on Friday. Bullish stock here at Chaikin Analytics. Strong trend, strong industry group above a rising long-term trend line, outperforming the market. So bullish stock outperforming in a strong industry group. That's the type of name you want to own. Then the question is, when do you want to own it? Well, we want to own it when it's in an uptrend. Yes, check the box. We want to own it when it's oversold within the context of that uptrend. Check the box. And ideally, we want to see it being accumulated. Chaikin money flow being bullish there. I can check the boxes on Green Dot, which tells me that odds favor this being a name that could outperform. Does it guarantee anything? Absolutely not. I have no idea if it's going to outperform or not. The odds favor it going to outperform. I like the setup. It looks interesting to me. It's in an interesting space that sometimes gets overlooked, i.e. the stock gets overlooked because everybody's focused on PayPal and everybody's focused on Square. And then there's Green Dot over there just kind of chugging along. And oh, by the way, did I mention there's an activist investor involved here? So take a look at it, maybe do some reading up on the stock. I think it's a compelling opportunity. We liked it down here in the 30-35 range. We like it up here around 55 to 60 as well, because the trend is up and we're oversold within the context of that uptrend. And there's a compelling story. Take a look at Green Dot. Sector tracker now, movement of the major sectors over the last 5 days. Comms at the top of the list. Really, it was that Snapchat earnings report that was a catalyst for the social media stocks, especially the big ad-driven names. Now, remember, we are going to see some monster earnings this week. We're going to hear from Facebook. We're going to hear from Google, okay? Those are names in the comm space. Those are names that are ad-driven. We're going to want to take a look at that. What does it do to your bearish narrative on the economy if these ad-driven names are strong? Right? Why would advertisers be spending money if they thought the economy was going to take a turn for the worse? Maybe things are better than people realize. Utilities top of the list. We're still trying to foot that one. Financials. It's really been the small cap banks. I thought it was going to be the major banks that sparked a catalyst for the financials. It wasn't. It's the small and regional banks that are actually helping the group at this point. Energy, counter trend rally, discretionary higher over the past week of trading. The downside, healthcare, materials, and industrials are middle of the road. Staples, REITs, and tech are bottom of the list. Now, as it relates to utilities, a lot of people might say, myself included, when you see utilities beginning to outperform, that's something to really get concerned about. My thing is, I think that if we saw utilities outperforming along with staples, I'd be more concerned. So I'm going to watch staples here. If staples start to come on and utilities are still strong, we're going to have to pay attention to the fact that maybe there's some risk developing under the surface in the market and want to pay attention to that. For now, we're hanging back. We're sticking with our views. We're sticking with our levels. Our industry in focus today, transport services, past 6 months, been a monster, outperforming the S&P by 17%. Solid power bar ratio here, 10 to 4 bulls to bears is strong, 12 of 21 subsectors. Take a look at names like Macquarie Infrastructure, MIC, ArcBest, ARCB, and Atlas Air Worldwide, AAWW, all very bullish stocks that are holdings in a fund that looks like this. Neutral rating, strong trend, outperforming bearish money flow. So it's a bit of a mixed bag where I'd say the weight of the evidence skews slightly in favor of the bulls here, but let's take it from a purely technical perspective. We are trading into resistance. All right. And we're going to want to see a breakout. This looks very much like the small caps, doesn't it? Looks very much like the IWM, which is kind of interesting to me. Likewise, you're seeing some juice in the near term on the outperformance. So that's also interesting to me. I think if you get a breakout here in the transports, it's hard to be bearish on the market. I mean, how can you be? Let's take a look at what's trending. Yesterday's S&P, or Friday's rather, S&P 500 movers and shakers, our gainers and losers. Silicon Valley Bank, kind of an interesting way to backdoor play tech through the financials, up 4% following their earnings. FLS, no news, up nearly 4%. Dexcom, didn't see any news, up nearly 4%. Norwegian Cruise Line probably trading higher on incrementally positive vaccine announcements, and a line following through after that monster day on the back of their earnings report the previous day. Loser side of the board, Intel's earnings down 10.5%, and the troubles just keep mounting at Intel. I have a feeling we're going to look back and could potentially say that 2020 was the year Intel became a case study on a former leader that started to go into decline. Think about it. It happens, especially in tech, happens all the time. Look no further than IBM, Big Blue. RHI earnings take 8.27% out of that stock. American Airlines down 4% following their earnings announcement. American Express, apparently people did leave home without it. Earnings sent that stock lower by 3.6%. And VeriSign earnings sent that stock lower by a little under 3.5% on Friday. So let's kind of dive in a little further into what we're looking at on the charts today. It's Monday. We look at macro themes, cross assets. Obviously, gold is one we get a ton of questions about. Gold here still just doing its dance, right? We had the breakdown and now the consolidation. I think I want gold. I want gold at 1800 to 1850. That's where I like it. Okay. I'm bullish gold from a trend perspective. It's up and to the right. It's above a rising 200-day moving average. If I overlaid the 50 on here, we're below it. Fine. Bigger picture trend perspective and everything that I'm seeing from a monetary and fiscal policy standpoint tell me to like gold, right? But the market doesn't care what I think. The market's going to do what it's going to do. And in the near term here, it's going to chop around. At least that's what it seems like. So for me, I'm watching gold. This is physical gold, the commodity. Okay. I'm watching 1800 to 1850, right? You get a situation where we get to 1800, we get the 200-day moving average coming into play. I think there's going to be a lot of money there ready to get involved, which is why we may not even get there. So I'm using a buffer zone here, 1800 to 1850 on gold. However, we have to be mindful of the fact that, listen, this is an obvious level. All right. I don't have any special insight here. It's an obvious level. Everybody's watching it. So we have to start thinking about the fact that we may not even go there. Okay. So if we start to snap higher, you have to think about where you're buying gold on the way up. I think it's 1950. And I think you want to take your clues from the miners because the stocks tend to lead. So if the miners start to move higher, you got to start thinking about adding gold if that's how you trade. 10-year yield trading to a key level here. It's hitting these declining 200-day moving average. Will it be resistance or will it break through? I have no idea. We can see that momentum is shifting to the top side. Look at the RSI of the 10-year yield shifting into bullish ranges. I think 90 basis points is the level we want to watch. 90 basis points is the level where you have a breakout. You then be through the 200, through this interim high here, and then you're probably playing for 1516 back into this level here where we were pre-COVID. Okay. So it's really what I'm noticing in a lot of markets. Actually, the best way to describe it is you had this massive disruption, excuse me, and now things are just kind of getting back to trend. Okay. So the trend was down. It accelerated. Now we need to digest that acceleration and maybe we just go back to trend. And if you drew a straight line, you'd probably be hitting somewhere in the 1.5 area. All right. If you drew the trend line. So maybe things are just getting back to trend. I don't know. It's just a thought that I had. And also, we know the Fed's involved here and they're probably not going to let rates lift too much through the 1.516 area. Finally, there's your dollar. Doing nothing. We're waiting for this one to break. Not much of a clue. But if we just take a step back, what do I see? I see the dollar index trading below a 50-day moving average, which is now turning lower again, and below a 200-day moving average, which is declining. If you break 92 here on the dollar index, you got to play lower and you got to play that stagflation theme. That's going to wrap us up for today. I'll be back tomorrow. Take us for a test drive. Have a great Monday, everyone.